Welcome to Piles Podcast, a weekly discussion of economic and market developments as they pertain to you, the client. This podcast is for information purposes only, and the author has taken all usual and reasonable precautions to determine that the information contained has been obtained from sources believed to be reliable.
Podcast for January 22nd, 2009. What is the bank thinking? Okay, I feel like I've been spending the better part of this month trying to remain upbeat and positive about the markets this year. And despite this week's stock market roller coaster, I'm still upbeat. I honestly believe that the new administration in Washington will deliver an economic and financial market stabilization plan which will work. In the very least, it should prop up business and consumer confidence and counter some of the pessimism that is being generated by the ugly fourth quarter numbers and news of a banking crisis in Europe. But I also try to do what I always do, and that is finding the common sense reality between the extreme bears out there and the euphoric bulls. Stimulus measures, whether from central banks or governments, take time to work. And even when they do work, it's not always in a straight line fashion. Apparently, this realistic view of the world is not shared at the Bank of Canada. Thursday's release of the bank's monetary policy report reinforced the message delivered by Governor Carney and crew at Tuesday's policy meeting. Specifically that things have definitely gotten worse. In reaction to the sharp contraction in the U.S. economy to continued financial market dislocations, Canada's economy has slipped into recession, and it will be painful this half. None of this is shocking news to either seasoned or armchair economists. What is shocking is how quickly the bank thinks the economy is going to rebound from this slump. In the monetary policy report, the bank estimates that the economy will contract by 1.2% during 2009, but then soar 3.8% in 2010, starting with a pickup in the second half of this year. Few people will dispute the bank's view as to the timing of economic stabilization, nor an actual recovery. Indeed, Mr. Carney is quite correct in pointing out that we are witnessing coordinated global stimulus initiatives that have never been seen before, at least in terms of how quick they're being delivered. If anything, my major concern over the medium term is how much debt countries around the world are going to be piling on and how this threatens to send interest rates shooting higher. Yet this does not mean that Canada will feed upon this stimulus immediately. Canada has been late to the recession party this cycle, almost a full year after the U.S. started and about half a year following Europe's tailspin. The last data point showed real GDP still expanding as of the third quarter, though the final quarter is expected to show contraction. Typically, whenever Canada has caught the economic cold late, it has taken longer to emerge from it. This makes sense given that there is a trickle-down effect from the initial impact, say on exports and manufacturing, through to employment, and then onto a greater cross-section of industries. Once employment begins to slide, then we also see the effect on housing, the very sector that has caused the U.S. economy and financial markets around the world to crumble in the first place. So what of past cycles? Well, the most recent recession back in 1990-1991 saw 4 consecutive quarters of contraction in real GDP, with the largest decline occurring in the final quarter of that episode. The total contraction from peak to trough was 3.4%. Which might not sound like it was that substantial, but it took 10 quarters for economic output to return to its pre-recession high. In other words, far longer than what seems to be implied in the bank's latest prognostication. That's not to say we haven't seen faster recoveries before. Take, for example, the 1981-82 recession. After the economy had reached bottom in the fourth quarter of 82, it soared the following year, returning output to its early 1981 peak in only 4 quarters. That's pretty impressive considering that total output fell by close to 5% over a space of 6 quarters. The problem is that there were 6 quarters of pain before the miraculous rebound. It goes without saying that while you can certainly generate a quick and substantial recovery from massive stimulus, there is a reason why we're getting massive stimulus in the first place. And the economic malaise that has gripped the U.S. and the rest of the world has only recently shown up in a material way in Canada. Of course, the other question that arises from the bank's optimistic forecast is why release something like this, which exceeds private sector expectations only 5 days before the federal budget? As much as the details of Ottawa's stimulus plan are important next week, There will also be a lot of attention paid to the economic forecast that the government is basing its budget plan on and how credible those forecasts are. After all, this will not be a one-year deficit situation, but one that spans a few years at minimum. How soon the red ink disappears will depend on how strong the economy is. One way to make the red ink vanish quickly on paper is to assume stronger growth. The question will be, how believable is that assumption? I'm Andrew Pyle, Wealth Advisor with Scotia McLeod. Have a wonderful and prosperous week.
The opinions stated are not necessarily those of Scotia Capital or the Bank of Nova Scotia. Scotia McLeod is a division of Scotia Capital Inc., member CIPF. Feedback or questions on this audio can be sent to podcast@andrewpyle.com.